Okay, Ibrahim, yes.
All right, the floor is yours since this is the second session.
Okay, great. Thank you. All of you that are here this evening, thank you for coming. I hope that I can give you something of value that you'll feel glad for having been here. So tonight we're going to do supposedly the Anglo-American, but it really amounts to American, what I'm going to be doing today. So I'll be starting up on that as soon as I see my PowerPoint with the screen there. Share. I'm not seeing it right now. Screen sharing. Okay. Okay, so this is the first one that we'll start out with. So tonight I'm going to tell you about, we're going to start out a bit on the English version, a little bit, and then we'll move right into the US version. Okay, so let's start with definitions again here. I know we went over that last week for all of you that came. If some of you didn't, then this will be for you then. We're starting up on that. Okay, so hang on, right. So definitions and characteristics. So capitalism is defined as this is the Anglo-Saxon capitalism, also known as the English capitalism. So this is the 18th century England origin. It was influenced by Adam Smith's ideas in writing. The modern free market, as a modern free market model, it came into being in the 1970 Chicago School of Economics. And as you may or may not know, that was originally founded and funded by D. Rockefeller, and he said it was one of the best investments he ever made. So it is the premier wealth generating economic system in the world. The US capitalism is known internationally as the Washington Consensus. And it's characterized by a free market economy with privatized production, distribution, and pricing. Let's see, hang on. Ibrahim, I wanted to get back to that last screen. No, there we go. Can I go backwards, Ibrahim? I'm going forward here. I see it, I got it. Okay, so there are low levels of tax regulations, low levels of tax and also regulations and public services, and a weak social service safety net. So low barriers to incentive of free trade, free regulations for labor markets, easy to hire and fire, strong property rights and contract enforcement, uses innovation to create competitive advantages and greater overall wealth generation than any other variation of capitalism. Now, that's the important point. I have to say a variation of capitalism because all of the variations of capitalism are usually discussed as or known as capitalism. It's not one singular capitalism. It's many different capitalisms, as you saw last week and you'll see soon as well. So it is a shareholder profit, and it's more important than the stakeholders' concerns there. And short-term profit emphasis is instead of long-term growth. And so there's no real success strategy there for long-term. It's all for the short-term. So Adam Smith's thoughts and quotes on this, since it was basically from his writings. No society can surely be flourishing and happy, of which the far greater part of members are poor and miserable. And labor was the first price, the original purchase. Remember this, money that was paid for all things. You paid with your labor. It was not by gold or by silver, but by labor that all wealth of this world was originally purchased. Little else is requisite to carry a state to the highest degree of opulence, from the lowest barbarism, but peace, easy taxes, and a tolerable admission or a tolerable administration of justice, all the rest being brought about as a natural course of things. Okay, so this is a sampling of some of the models that we'll be doing as well, other than what we're doing. What we're doing right now is the English version, the Anglo-Saxon. And it pretty much compares with Continental, which is the European version, but it's less inequal. The Continental version has less inequality and low levels of poverty, more state control, and more wealth distribution focus. In particular, Sweden, that comment was, but it also applies a bit to England, but not quite as much as Sweden for sure. And they prefer community bankers providing investment financing, not US or UK financial engineering. So that, of course, we're talking about the Germans there. And the Asian model is more similar to the Continental than it is to Anglo-Saxon or the US one. So the Continental model, let me just say really quickly about that. It comes from the economic principles of 19th century France and Germany, has less inequality, low levels of poverty, state control, community bankers, as I just mentioned. And also, it's averse to stock market volatility, where emotions dominate, as in US and UK. And it's more corporatist model with state industrial policy, long-term bank and business relationships of cooperation. This is German version for sure. And they operate within high taxes and high government spending structure, the Nordic version, and they have more state ownership. And the Asian version tends to be closer to the Continental, and it's highly structured to each society to a high degree of state control. And focus is on greater rates of capital formation, many variations to fit a national and a cultural particulars of each country. Okay, so we'll do a very quick history of the market-based economic systems. Now, when you're talking about a market-based economic system, you're talking about capitalism. And then all market-based economic systems are simply referred to as capitalism these days. So two economic models dominate in the 20th century, market and command, and both of them have numerous subtypes, but the command model subtype uses different names. Now, then the command, that was such as communism and socialism and fascism. And then the market-based economic model were all called capitalism by the time of the 20th century. So capitalism is directly opposed to all command models. So capitalism certainly has a lot of critics. And the differentiating between different subtypes is important because they help you understand the evolution of capitalism, how different versions of it played out and how they became the way they did. And so one of the first versions that happened then with England was mercantilism. That's basically what England started out with right after feudalism, and they went right into mercantilism. And it replaced the feudal system, 15th to the 18th century, colonizing foreign lands and creating more foreign wars than ever before to control resources. Europe became wealthy, opening up new sea trades to the Americas, Africa, and Asia. Now, in mercantilism, the interests of state policy and a merchant commerce intersected. Now, this resulted in monopoly and also state subsidy for companies contracting for the state. So that relationship that started back then is still carried on these days. Now, this example became the norm between public and private cooperative efforts. So the rise in joint stock companies also was another invention of capitalism, and it was in particular with England, because it helped fund the voyages. It would be very expensive to fund these voyages to go off to foreign lands and then bring back all kinds of merchandise. But it would be extremely rewarding. You know, the British became extremely wealthy for that, and they controlled the high seas because of it. So nations increased trade by finding new colonies to return raw goods back to empire. Colonialism and mercantilism made for a regressive feudal economic system. Early mercantilist doctrines of economic strength required a positive balance of trade. In other words, exports must exceed imports. It became a state policy. Now, Adam Smith later refuted this concept as being a form of selfish wealth extraction, but not economic individualism, as he wrote about in his book. But it was really just an extension of feudalism, because let's face it, everybody was going to war to find a trading partner or to own someone's estate. So by importing precious metal and raw material, then adding value to them for resale and profit, the Industrial Revolution's success came from using cotton from India and Egypt and exotic wools like cashmere that became textiles, which brought great wealth to England because the whole world was buying textiles from them. So mercantilism accelerated the national transition to a monetary economy from a land-based economy. That was still being refined by an agrarian capitalism being gradually in place back in England. Now, Adam Smith saw mercantilism not as a force of development and change, but as a regressive system, creating trade imbalances between nations and keeping them from advancing. His ideas for a free market opened the world to what became known later as capitalism. Now, wealth extraction in mercantilism wasn't an acceptable principle of economic individualism, according to Smith. It benefited only the factory, not the laborer used in the factory production or the consumer. So to summarize, let's say capitalism saw wealth creation as essential to economic growth, but mercantilism felt economic prosperity was best achieved with wealth extraction in the eyes of Adam Smith. That is the philosopher's eyes. You have to remember, he wasn't really an economist. So capitalist society was for a competitive market structure, unlike mercantilism, that clearly backed monopoly as an extension of the crown. And Adam Smith encouraged consumer spending and life's enjoyment in principle to foster economic growth for all. But mercantilism discouraged consumer extravagance to prevent monetary outflow from a growing national economy. So after mercantilism came colonialism, which really fit like hand in glove, or glove in hand, whatever you want to say. And the governments colonized areas for access to markets and raw materials for national-based capitalist firms, which were some of these trading companies and joint stock companies that had formed. And this started in 1490 when Portugal annexed Ceuta in Morocco. It's on the Mediterranean coast, and it's actually part of Morocco, and it was set up for doing trade. And it was still predominant in the 1890s, having continued so long as a response to various economic crises in the latter 1800s in Europe. So industrial capitalism is the next form. So that took place in the first two industrial revolutions in England and the US. And what was the characteristic of this was when heavy machinery usage was involved, there was a much more pronounced division of labor. And then the next version we'll talk about is monopoly capitalism. This saw the rise of monopolies and trusts dominating industry and other aspects of society. During the late 19th to early 20th century, and in particular, the robber barons controlled the US economy. Now, the Sherman Antitrust Act of 1890 outlawed monopolies and cartels to regulate interstate commerce and increase economic competition. And of course, again, with Adam Smith, the whole thing was about increasing economic competition and not about monopolizing. So another version was Keynesianism, and that was developed by British economist John Maynard Keynes during the 1930s. And it's a demand side theory. Its demand side theory advocated spending into economy for effects on the output, employment and inflation. So government expenditures along with lower taxes were used to stimulate demand to take global economy out of depression. So Keynesian economics theory focuses mainly on the short run to change the variables to adjust the economy. And then we have welfare capitalism. In mixed economies, governments use social welfare safety nets to mitigate the worst abuses of capitalism. Welfare capitalism occurred mainly between 1945 and 1973. So you might remember, if you're here in the US, this was when they had declared the war on poverty, and Johnson and other presidents at that time were they're throwing a lot of money into building homes for everyone and also to help people get out of poverty. So when the major social, and some countries that do this have a major social safety net, like Sweden. The US used to have it. They had it at them. I remember back then at that time also, they had job centers. People could go to job centers and learn a trade. So at one point they had that here in America. So you see, capitalism continually evolves and changes. They left it behind. They didn't stay with it, but they did have it at one time. And America was more or less a nation of shopkeepers there in the beginning, in the 1800s and the early 1900s. So another aspect of a type of capitalism is mass production. Now, this took place during the post-World War II shift of focus. And of course, this was because the Americans, as I will get to it later, did a spectacular job of production during World War II. So, and they gave the rest of the world the other idea, as did Henry Ford with his moving assembly line. So there was a rising major corporation power focused on mass production, consumption, and employment. And most importantly, it saw the rise of advertising to promote mass consumption and give significance to economic planning occurring within firms. So after that, we have mixed economies, and they were the new post-war initiative with a free market, with entrepreneurs and private business. However, the state had a strong role of intervention with regulations and policies to limit inequality. Most of these developed in Western Europe after World War II. And another one, state capitalism, more or less applied in those days to the Eastern Bloc countries and also to Russia at that time. And corporatism. Government policy and law prefer and share special benefits to large corporations known as big business. The combination of both corporate and government power so that government becomes in service to corporation. And that's corporate government and a corporate state, and it's called crony capitalism, according to Ralph Nader. The Trump administration considered privatizing Fannie Mae and Freddie Mac. And at one time, they were a very successful $5 trillion mortgage fund, proven to be a very profitable GSE, that's government state enterprise. after being rescued during the 2008 crisis. But in 2015, the government swept all the profit out of it without any shareholders being consulted. So there's only a couple more that I'd like to really get through. Of course, there are many more, but as far as will pertain to our interest, maybe one other one. So free enterprise, just basic, like a laissez-faire. And then there's financialization or financial capitalism, which occurs when nations shift out of industrial capitalism and manufacturing is sent offshore. Financial parts of the economy predominate: finance, insurance, or real estate sectors. Economic activity shifts to ownership of assets, credits, rents, earning interest, rather than maintaining actual productive processes. A rentier society takes over the economy. Business and services under city, county, state, or federal control as a public benefit or service become privatized, supposedly for the better, to become cheaper or more efficient and better managed. Now, one of the most eye-raising examples of this trend has been the for-profit business prison industry. And
Michael,
it becomes privatized. Yeah,
Mike,
and
I don't know
I
if
just
you
want
are
to say I'm kind of stuck on this screen, but there's the
okay.
next
Yeah.
one. We'll get there. Thank you. And they're paying people like a pittance, like $1 an hour to work. It's a captive clientele, so to speak. No pun intended. But when you're in the jail and the only job you can get is the job they're giving you, and they use that, and even they negotiate contracts with the state so that they'll get paid for every single bed in the jail, and that unfortunately has to incentivize the state to keep the place full, which it's not such a great idea to try to be beholden to the prison industry to keep the place full. It's like it's like they have the franchise on your hotel business and you have to keep paying them. So other examples even include municipal parking, water, energy, transportation services, things like this. And for the last few generations, these subtypes of market economies have been lumped together on all labels of capitalism. So currently developing models using hybrid state capitalism have seen growth, and they are mainly Asian countries like the Chinese model. Okay, so let's start out now about the US, and we're going to talk about after the war, the US guided the post-World War II economic recovery with a Marshall Plan, but that was basically, they were just turning a credit. Here we go. They were just turning a credit into a sale, because the only one that had goods in those days was America. Everyone's, the manufacturing basis for all the other countries had been destroyed. So US capitalism rebuilt Germany and Japan's economies, giving prosperity to both. The communist threat of a new Cold War left them no choice. And the Korean conflict actually did help Germany and Japan factories make a quicker recovery, since they were supplying them for the war effort as well. So the US becomes the world's sole currency reserve at Bretton Woods in 1944. So their post-war World's Monetary System Conference. This put the US at a great advantage, being able to take a transaction percentage on almost all foreign trade that was not forced, but needed to use dollars to transact. So this was a great advantage for the US, and still is today. So nations would now have to stock up on US dollars just to trade with other countries, and nations would now have to, they would have to also pay the exchange fee for that all the time. So it allowed us to also restrict countries from using SWIFT code for money transfers. You know, international SWIFT codes is what trade when you buy something from abroad. That's how you pay. So countries could be isolated anytime, like Iran and Russia and others have been with punishing sanctions. Okay, the Berlin Wall fell in November 1989. That signaled victory of free market capitalism over communist and socialism's failed command economies. Now, capitalism won the Cold War, and a new unipolar world resulted. The rest of the world began adapting to capitalism in various degrees with mixed economic models. Yugoslavia held out and became balkanized again into 7 different independent states, ending the socialized market experiment that existed under Tito with some measure of success for a limited time before his death in 1980. And if you want to see a good video about that, there's one called The Weight of Chains, and it's in 2 parts, and it gives a very good background to that. Okay, so that's it. So we're off and running. So let's look at this. So let's look at this. This is a visualization of world capitalization. And if your geography is expanded by as your capitalization is. So this is why America is so big in this picture. And then other countries are much smaller. China, for instance, is so small in this. But this was back in 2015, I believe, yeah. So that's probably one of the reasons. So let's look at another one. Now here it's quite clear that the capitalization, market capitalization in the US is way above everyone else. And this is from NOMA, it's a data group. And you can see it's almost like 5 times what it was China at that time. Now China is great. China's turning a lot of stuff out, but it's happening consistently. So you can just, I put some of the main points on the bottom here. You can just see them as well. It says this was in 2018, top country in market capitalization, 30 trillion in US dollars. And it said that it amounts to about 45% of the world's market capitalization. But then I don't quite understand this when it says 5 other countries account for 71%. So that doesn't make 100. So there's something not right there. I'm not quite sure what it is. And then also at that point, they said 2018, the capitalization in the world was 67.6 trillion US dollars, quite a sum. And then here you have, out of the top 10 companies, top 10 capitalized companies in the world, 7 of them are from the US, 2 from China, and 1 from Saudi Arabia. And Apple is the only one to have breached, so to speak, $2 trillion ever. They did it. And then, unfortunately, in this capitalist version that England had and the one that the Americans have, it's highly volatile and cyclical. So there were a lot of, these are some of your lesser and greater, the booms and busts. So they take place generally every 15 to 16 years. Of course, some overlap. Only the Great Depression beat the 2008 submortgage crisis in severity. And on Black Monday, 1987, to 88, was the largest single drop of the Dow Jones Industrial Average on record, largely blamed on program trading. So, but what's really interesting here is that I want to, let's go forward to the this data sheet here, so to speak. So look in the middle section here for World War II. And this is quite interesting here, because in that war, it was the most extraordinary mobilization of an idle economy in the history of the world that transpired. So 17 million new civilian jobs were created. So industrial productivity output reached 96%, and corporate profits after taxes doubled. Government spending spurred business recovery that eluded the New Deal. And if it hadn't been for the war, it's doubtful if the U.S. would have ever made it out of the recession. But the war certainly did the trick. And I mean, that's why, sometimes you hear a lot of people, they want wars. This must be one of the reasons they want them. So only America saw expansion of consumer goods despite wartime rationing. By 1944, wage increases in overtime pay and weekly wages before taxes in manufacturing sector were 50% higher than in 1939. So, the U.S. of course had the great fortune to be protected by 1,000 miles of ocean on both sides. You can't beat an advantage like that. And then you see on the bottom some of the other. As far as if you're looking for causes here and everything, finance is in there. The FIRE, that's it's finance, insurance, and real estate. That's what that stands for. And there was two of those, and then war. There was two of those. There after the oil war in the Middle East, and then technology, of course, is always upsetting things. So here we're back to Black Friday. So it started out in Hong Kong, then it spread across the globe to Europe, then the US. Exchanges could not lock out of new program trading orders in a crash scenario. Now, it was a domino effect. Falling markets triggered more stop loss orders, frantic selling, new stop loss triggers, and then an irreversible downward spiral set in motion. These new programs also turned off buying options simultaneously, so bids for the affected stocks vanished across the board. Warning signs similar to past excesses at previous inflection points were all there. It was a time when betting for and or against stocks could reap benefits. A new financial product, portfolio insurance, fueled more risky behavior. And then program block trading took much of the blame. Exchange lockouts and some Fed intervention, never explained, occurred mysteriously later that day. Like then the highs in the next mark, the highs the market plunged from in one day were once again there the next. So program trading claims to protect every single portfolio from risk. It was a fallacy. It was the opposite. It was the greatest factor to risk and market instability. So new precautions introduced, slowed down irregularities, and gave the system time to adjust. So this is interesting also. So you see here, this is the millionaire's tax rate over time, how it happened. And the same time this was happening in the 70s, there was also when the American version of capitalism was taking place from the Chicago. And then also what Minsky called money market capitalism. And these were when a huge sector of the economy, the finance, would be controlled by these money market managers. And this changed everything. And we're going to be talking about this as well later on. Okay, so you see, they had a 66th percentile tax rate during the war. And before the war, it was 1.6% when they started paying taxes in 1913. And then later, off to the right side, you see it as being down like 32%. So there's a lot of questions here about, all this that happened. So let's move on to the next slide. Now, I apologize for this. I don't have a lot of color in here like I usually have, but there are a few more like this. So capitalism depends on consumerism for labor, consumption, and actually debt maintenance. Consumers are what drives capitalism, not capital. In the 1700s in Northern Europe, economies expanded and wages rose. This was a historical first. Shopping had arrived, and as economic expansion continued, shopping choices kept growing. These expenditures created a virtuous economic circle. The more that was spent, the more the businesses grew, the more wages were raised. It was the first consumer revolution in economic history. By the middle of the 1700s, it was clear this was a remarkable period of history, never seen before, happening before their eyes. The first consumer revolution. Wealth and possessions were no longer taken by force and war. A cycle of wealth generation was now possible through hard work, and the consumption made possible by the wages of this hard work. In England, the changes were the most remarkable and visible on a far greater scale than elsewhere. Businesses were springing up to meet widespread demand for goods previously only available to the rich and privileged. So in 1936, Keynes originally stated, aggregate demand fuels capitalism. In post-World War II, with the economy handoff to the money manager capitalism, manufacturers made goods in response to consumer demand. But during the war, they didn't necessarily do that because actually a lot of people complained about that. They thought that Roosevelt they accused him of being a communist because he was just hiring large industrialists, and they would just do planning and make product. But there was a war on, so there was a shortage of goods. So anyways, manufacturers made these goods in response to consumer demand as best they could, which gave growth to a whole network to form consumers and delivery system to the end user. Any breakdown, disruption of this network causes diminishing returns of capitalism. Diminishing profits leads to a support network collapse that contracts to sustain new levels. Now, disruptions in the network of a new financial engineering had arrived. In the 60s, a new financial innovation to raise personal debt, plastic credit cards, immediately available, unsecured debt with high interest rates, penalties, and fees. By the 90s, spurred by rising real estate values, consumers' homes were their ATM card. But worst part of that was in 2001, after China joined the World Trade Organization. Since 1999, 6 million jobs were lost, according to a May 2018 article. And you'll see here as well. China joined the World Trade Organization right around the turn of the century, like December of 2000. So by 2001, you can see up the bump there at the top, and it goes all the way down to 2010. And altogether, at that time, a huge number of jobs, 6 million jobs were lost, according to that one article. Okay. So this is a Harvard professor, as it says here, and a behavioral economist, recently asked more than 5,000 Americans this was a number of years ago, this is an old slide, how they thought wealth is distributed in the United States. Most thought it was more balanced than it actually was. And they were asked to choose their ideal distribution of wealth. 92% picked the one which was even more equitable. So you can see the actual, what it was, and what they would like it to be on the bottom. So this brings us back to a point. Now, all this is happening right around the 70s. It's a time also when the dollar has gone off the gold standard. It's also a time when the neocon are taking over, not taking over, but in other words, economists, American economists are winning Nobel Prizes. They're becoming very popular. So they're being heard. So this is about wage stagnation. And it just happens like clockwork. Look at this. All of a sudden, right around 1973, it just flatlines and it never comes up. It does come up a little bit, just so people can't say it never comes up. But it hardly ever comes up again. And you can see here, it just goes, and the productivity line, it keeps running straight. So what do you have up there by 2013? The difference between compensation on the bottom line and on the top line. 243.1% gain on the top line, only 108.9% gain on the bottom line. So here's some more. This is from a sort of economic policy group, and they'd put this together a number of years ago, and I put it aside at that time. So it's by the Economic Policy Institute, and it reports in its report entitled, this one here was Wage Stagnation in 9 Charts, clearly says no abstract economic trend causes wage stagnation for a vast majority of America. Wages are suppressed by policy choices enacted by those with income, wealth, and power. It's not for nothing, you know? So if you keep, I've got all the information there and circled in the black, and you can see from that the chart on top of that. You have the top 1% had a 138% increase in wage, whereas the bottom 90% had only a 15% incremental increase in wage. And the same here on the bottom, you'll see that as well. It breaks it up into 3 groups. The lowest wage is a minus 5%. It doesn't even in a positive level. And then the middle one is like the shadow or the reflection of the other one, 6% increase, that's it. And then of course, the very high wage is like 7 big shadows for 6%, 41%. And let me just back up a few. One of the other things I want to say, let's realize that it took like 50 years for all the New Deal depression and period policies to be wiped away. Finally, the Securities Administration, Modernization Act, and Glass-Steagall were removed, which many people believe led to the 2008 crisis. And it seems unlikely such policies will be enacted again at this point after being so diligently removed over the last decade. So here, now, let me. Okay, so this one is the CEOs, 296 times what a typical worker earns. And eventually, that's what it got up to in the end, but at one time it was up to 383. So that's pretty much how most people rate inequality. They look at the difference between the CEO and a regular worker. And of course, in Europe, it's much lower. And this is how Sweden fights. This is how Sweden and other countries like Germany, they fight inequality in this way. They try to keep that spread down, not quite as high as it is here. another one. So you can see yourself just looking at some of this. This is about what the federal minimum wage should be or could be, and what it is, and where it is now. So you'll look and you'll see on the bottom, this was at that time, 2010 back then, or 2000 when they run the study. I think it was in 2012. $7.25, and then what it really should have been had it, right after the war through the 50s and through the much part of the 60s, it was quite. America was on a roll. I mean, workers were getting increases in wages. And then all of a sudden around a certain time there, around the 70s, it just sort of it flatlined. It went flat. And then of course, up here it says it could be 18.42. So if you manage to get this site and manage to link up with it, you'll see in the bottom, in the middle, they have that bar across. This is very clever. You can run that bar all the way across to see whatever the productivity point is at any point along that blue line. And then now we're going to be talking about Minsky. So I think what I'd like to do is, if Ibrahim is there now, I'd like to show a video that I have already ready to show. So I don't know if we can.
To show the video, you'll have to stop sharing the slides, and then we have to go back, repeat the same thing, but pick the video instead of the PowerPoint.
Oh, I have to come out and go back in again.
Exactly.
Okay, well, shall we try it?
Yeah.
Okay, so this is what we're going to view now. This is a quick primer for Minsky. If any of you are familiar with the economist Minsky, and he was 50 years ahead of his time. And he, of course, is famous for the financial instability hypothesis and the Minsky moment. They're all named after him. And then we'll talk about that when we come back. But let's see. It's a 5-minute video. It's very quick. So we'll all get back on. I hope you all join, come back, and we don't lose you when we go off, okay?
We're going to repeat the steps that we did before.
Okay, so I
Go
got
to share screen.
Yeah, share screen right here.
And the quick time must be there. You show it to me before, right?
Okay, here we are.
Okay, so what do you see there? You have your video on, right?
Right.
Okay, just select it and look on the right side. It says share sound.
Yeah, I've got it.
Optimize.
Okay. Here we go.
Okay. That's Randy Ray.
And
let me start from the beginning here.
Minsky started warning about the gradual transformation of the economy from a very robust financial system that was stable and which had no financial crises in the early post-war period, beginning in the late 1950s. And so he was 50 years ahead of his time. He warned that what would happen is that gradually over time, debts in the private sector would tend to build up, that increasingly risky financial innovations, they had already started to occur in the late 50s, and that those would increase over time, that stability itself is destabilizing. I mean, he's very famous for this statement that although things appear very stable now, he's warning in the late 50s, gradually over time, that stability will build confidence to take increasingly risky positions in assets. So that all of the New Deal structure that had been put in place in the economy during the Great Depression, the tremendous buildup of government debt in World War II, which we can talk more about this because Minsky's view on government deficits is very different from the mainstream view, that all of this debt gave a very safe asset for the financial sector and for the private sector, and that this would be in a sense leveraged. Safe government debt would serve as the basis for leveraging and increasing private sector debt, so that gradually over time, financial innovations, getting around the regulations of the New Deal would lead to a fragile financial structure, that we would start to see some financial crises. But because of the, what you would say, the big government, that is Treasury that had become about 20% of GDP, and the big bank, which is the Fed, which would intervene in any financial crisis, we would quickly get out of these crises. And so we really wouldn't learn much from the smaller financial crises that we would have. We would quickly recover and we would resume our path toward increasing fragility. And in my view, he was exactly correct. He did, of course, extend his analysis, deepen the analysis, adjust it over time. He continually worked on this from the 50s until 1996 when he died. So he would take account of the new innovations and include those in his theories. But I think that the economy did follow this path, and we saw increasingly frequent and increasingly severe financial crises over the post-war period. The very first financial crisis was in 1966, and just as Minsky had predicted, we got out of it very quickly. There was really no recession or anything like that. And then we had 1970, 1974, 1980, 1982, 1987 stock market crash, around 1990, probably all the big banks in the United States were insolvent, and then on to the current crisis. So a lot of people say that this is a Minsky crisis. People have used the term the Minsky moment. And so lots of people have become aware of his analysis, but they're not really, I think, incorporating his analysis in their analysis of this crisis, because they're dating the beginning to 2002, 2004, something like that, whereas the beginning of this crisis is 1951. So it's a Minsky half century. It's not a Minsky moment.
So Ibrahim, share screen. Okay, we're back. So I think the movie's still playing, right?
We are only seeing the slides, so you can go ahead.
All right. So yeah, so I want to talk about this one, the financial instability. So in this, this is why capitalism is prone to long periods of financial stability, then to instability. It's a type of market failure that requires government regulations. Now, more than 50 years ago, he put it in the warning, and no one paid attention because he was way ahead of his time. And with continued stability, housing and asset prices, everything going great, lenders and borrowers become over optimistic and take greater risk, and banks reduce deposit requirements, and it just keeps happening over and over again. And you see, how the cycle goes: normal borrowing, steady growth, economic boom, speculative borrowing, then Ponzi scheme borrowing. It's the only way that it can keep the enterprise alive, and the economic downturn eventually happens when it goes bust. So here, this is Minsky's other theory. It was a finance-driven theory, and this is how he was able to ascertain how everything happens through finance. And he has the three different questions for each stage of capitalism. What's being financed, what's the pivotal source of the finance, and what is the balance of the economic power between business and banking. And then he split it up into four different groups: commercial, financial, managerial, and money manager. And the question was the financing of, you wanted to get a look to see at this, what each group did, how they basically used the finance industry. And the financing of goods and process happened, the commercial capitalism, storage, inventories, or transit. It was basically for merchants. When the US was a bunch of small merchants, this was the type of capitalism that was ongoing then. And sometimes economic power was fragmented, dispersed, and decentralized, community oriented. And then it switched over to financial capitalism as soon as there was expansion with railroads and mills and the discovery of steel and industrial enterprises. And that was characterizing the financial capitalism there. During the stage, investment bankers dominated the economy and was highly centralized. And this was the same time when the robber barons were making a lot of money as well. And then the other version is managerial capitalism. And this financed macroeconomic revitalization during Great Depression, the New Deal, and the war. And federal government fiscal and monetary policies. A lot of people would have called that socialism, and that was what was happening during the war. So it helped ensure economic growth and stability, and household business debt was kept at a minimal at the war's end, and economic power with corporate managers in oligopolistic markets, not private bankers. So here's some statistics to look at to see what was going on then too. So money manager capitalism took over 1950 to 1990. Control of US corporate equities rose from 8% to 60%. Pension funds increased from 1% to 39%. Corporate debt rose from 13 to 50%. Institutional investors tripled in the 1990s. Mutual funds experienced explosive growth, 1998 to 2001. Total funds rose from 4.8 to 6.9 trillion by 2001 majority of 52% of US households had and held such funds. So money managers became masters of the economy by the early 1980s, obliged to maximize shareholder asset values for quarterly reports. They pressured corporate managers to take steps to raise share prices. Block trading of billion-dollar funds created greater market fragility as well. Just large sums of money that would be quickly deposited then removed. And so by 1980s, the merger and the M&A activity more than doubled between 1980 and 1988, merger and acquisition. Leveraged buyouts rose by a factor of 10 during that same period. So it was basically like Schumpeter's creative destruction. They were getting rid of people that were no longer economically relevant. And, a lot of farmers went bust in those days too. The farmers just couldn't compete anymore against the monoculture. So it was a great cleaning out of society then to prepare us for the digital age, I guess. So here you see it on a, and you can see how it's spread out. Where households, what they're holding. I think this is a share of corporate equity, mutual funds, pensions, retirements. How you can see it looks like a tsunami. It's rising here. It's starting like right after the war. And you look at 2014, how high it is. So other things were happening then too. And then in particular, what's particularly disturbing in this time of money market management is money market capitalism, you would call it. As 2008 food crisis and the commodity market bubble. It just so happens that food, a lot of staples went up like 25 to 30%, quite a bit. And a lot of people went into food insecurity, not in America so much, but outside of, in foreign countries. So the game was drive prices up and then down, roll over contracts to buy new ones. The same thing that they did with with the other stuff they've been doing. They just pick an item and pump it up, then dump it. So having derivative bets on these outcomes that trade on the OTC, the over-the-counter market. Now the OTC is a dark market. It's completely outside of regulation of the SEC, and it's essential for global derivatives trade. So automatic rollout of continuous long-term contracts, it creates what was called a demand shock. The machine, so the AI is correct on this, since the demand is for quantities that the computer has never seen. So massive amounts, these high book value figures, real and virtual cash, used for day trading by leveraging like $5 to hold a $100 position. Use the other 95 for block trading. So either way, they made money because the interest rates were very cheap then. Or they'd buy conservative, treasury bills and sell them volumes by shaving a few points off to make a little bit of money there. But they couldn't lose the way they had it. So how it works here for the commodity index market. The commodity index fund, heavily influenced by oil for transportation. Nothing that we use just appears to us. It all has to be shipped to us and it travels some distance before it gets to us. And then other commodities with upward mobility too, as well, were grouped. And derivatives based on the index fund, but to bet on either positive or negative. Now, all food and metal commodities continually rise due to demand and supply. Now, waiting for the prices to go higher, Goldman did this with aluminum in Detroit warehouses. What they did is they would just have all these drivers driving it around from one warehouse to the other to make it look like they were active and actually doing business, because they were required to do so many transactions in a month. So they had to make it look good, but they were just holding on to the aluminum. And then eventually the car manufacturers, they need to buy these big blocks of aluminum eventually to make a car. And they were sitting there. They speculated. The price went up. They made money on it. So all food and metal commodities. So waiting for prices to go higher, Goldman did this with aluminum in Detroit warehouses. They brought the business that warehoused the aluminum and controlled delivery. They bought it. And the obligation to ship daily quotas fulfilled by driving loaded trucks back and forth between different warehouses to satisfy the daily obligation. But at any time you could make a phone call to Nestle's or Cargill for other large overseas companies to buy back commodity stakes in certain items. They used to use people for that purpose too. So the other thing that was happening at that time was called the weight of money. Big money, destabilizing momentum of large blocks of cash. Block trading in the 80s made institutional investors, masters of the universe. This new fierce trend brought instability to markets. Like a guerrilla tactic, moving large blocks of cash strategically exploits and confuses market systems. Institutional investors use program trading and large blocks of values and stocks simultaneously to take advantage of timely market inefficiencies and weaknesses. And this was the case of the 1987 Black Monday market crash, for example. It was caused by computer programming trading. New financial trends continued through the 90s, driven by the unrelenting force of profit motive. And in 1991, Goldman and others got exemptions for contract limits in the commodity market for futures, for the CFTC, the Chicago Trade, what is it, CFTC. So the Chicago Board of Trade, they were able to have 70% speculation on that market. It ruined the market. Those markets are basically done for buyers and sellers of the commodity to spot prices up on a daily basis, so that finally when the grower has a crop and they bring that crop to market, someone's there to buy it. And they totally ruined that whole system. And the farmers, and then also the big wholesale buyers that buy the grain, they couldn't use it because the commodity speculation had wrecked the business. So future buyers are buying and selling daily to clear their positions. That's the normal way banks bought long on wheat futures, then rolled them over and bought even more on top of that continually rather. Only accumulating a historically unprecedented pile of long-only wheat futures that, in this case, an unnatural and artificial demand to buy confuses the system, sending price higher instead of lower. While messing up the structure of the market, they are protecting themselves outside the market by collecting large pools of cash by replication. They only advance $5 to hold a $100 position for their day trading. So, when they buy these treasury bills and they shave points off of them in a few volume trades, they do make a lot of money. So they are very much after accumulating large pools of cash to be used however they want, on a daily basis, when they're making more money on day trading and on their commodity index fund, with the inflated commodity shares being pushed up in price from demand shock. So I think there's one more slide that I want to view about financialism, and I've got to bring up the other video for that. I should put it on the screen earlier. So let me go out and bring that up now. Ibrahim, I'm going to have to sign back in then, I think, because I didn't put it. I should have put it on the board also the other time with the first film.
Actually, you don't have to, Michael.
Oh, I don't. Okay.
Yeah, just go where the video is. Just run it.
Mm-hmm. So let me.
I also want to let you know you have only 13 minutes because we need to have Q&A. So if you can just.
Okay, fine.
Yeah.
Hmm. Let me see. No, it's in this folder here on this other side. Hang on. You know, Ibrahim, so why don't we just go direct to questioning on this? Okay,
right.
and we'll stop down that since we'll get some questions in. Okay,
Okay,
and then I can
so
show that another time perhaps. Okay, so let's go direct to questioning.
good. So we are open for Q&A. Let me, you may unmute yourselves if you want to ask a question. I see Michael is very active on the chat. Michael, do you have a question?
Yes, well, I've been listening in and I have been active in the chat. And I take a bit of an opportunity to devil's advocate. Going back over the course of this presentation, and maybe I misinterpreted, and I mean no offense, and please don't take this the wrong way, but I feel like I picked up on a lot of messages about the negative aspects of our economic system. And there are negative aspects to our economic system. Income and wealth are certainly not evenly distributed. And there's a lot that could be improved on. There are market imperfections, and government is supposed to play a role in correcting those market imperfections, but it's not always effective. In any case, what would the speaker recommend in place of our system? Or are we back to the old adage about something akin to the old saw about democracy being the worst form of government except for all the rest? I'm a big believer in Adam Smith's invisible hand. I think the free market actually allocates resources rather well in most instances. And what is the alternative?
So do you want me to respond to that?
Yeah, go ahead, Michael.
Okay. Yeah, so I mean, it's true. This time was more about the negative. I mean, the last time I was very positive about it. And I mean, it's capitalism. Capitalism is consistently moving all the time. So we're still, you know, you can't really get a stable form of capitalism. It can't stand still. Now they have tried it. If you know, when we do the Swedish and the German version, you will see that there is an option in their style, what they do, the way they have it. But it's related to their culture and their society, and that's why it works for them. You know, it would not work for a lot of us here in the U.S., and it would not work for for other people. It's some people that do go there, they like Sweden. They're quite they like that the government takes care of this, has a social welfare safety net to be there for them. They don't have to worry about it. Some people like it. And I mean, I don't advocate capitalism as being bad, but you know, there's definitely, you know, the American version of capitalism. It's a kind of like a chaotic capitalism, you know, but nobody certainly, I mean, myself included, wants the other version. You know, it's like Churchill said, you know, the difference is that capitalism shares good things with everyone and the socialism shares bad things with everyone. You know, so, you know, you have to give Churchill his due for that. You know, it doesn't seem there's not much history of them working. You see what's going on in Venezuela today, and you see all these people that have left countries. You know, a lot of the refugees and that are coming into the U.S. now a lot of them are from Venezuela. So I mean, I agree with you. I'm a bit hard on it, but I was trying to present that, and last time I did present, I was very overflowing about it and saying that it's the best system that's been that you know, it's created more wealth and it's taken more people out of poverty than any other system.
Michael, just to piggyback on that question, I think at some point you presented a picture of American capitalism, which you called the Anglo-American one, from the days of the New Deal all the way to the early 1970s, where we could see productivity gains and wages going to labor just locking and going together. When productivity was rising, workers were also getting a bigger share. So, and then suddenly in the 1980s, we started seeing a divergence. So what I want to know is, what are the reasons that justify that switch?
Well, there's the rub. I mean, that's the big question. But it seemed to all be happening at the same time. You know, when the currency was no longer pegged to the dollar, right there in the 70s. You know, the end of the 60s, the beginning of the 70s. You know, a big switch was made. I mean, the data is conclusive. You see how wages have not increased for lower levels. Now, all the way up to like about 1948, like right near the end of the war, early 50s, so whatever, you always saw a continuum between, you know, pay raises and also production. But however, maybe it just maxed out. Who's to say? But you know, and then you see these other countries what they've tried. Now, well, I'll have the German talk next week as well, and then after that will be Sweden, and you know, so I would, you know, come see them if you want. I'm not trying to beat capitalism up, you know, but definitely I presented most of the stuff that, you know, comes out negative this time around. But you know, capitalism will live to another day. Like what's going on now? How would you look at what is happening now in terms of capitalism? It's hard to say.
Good.
Yeah.
Thank you. Tom Rossman has a question. Go ahead, Tom.
So sorry, I was having a little trouble getting unmuted. Yeah, so I think, you know, I study this a lot. I'm with a group called the Junto Group, and we're developing a new economic model for society. And I think the characterization from last week, I think, was really good in terms of looking at the different forms of capitalism. And one of the things that changed in the 1970s was we went from what's called the stakeholder form of capitalism, where corporations perceive themselves as being responsible for their workers, for the cities and where their plants are, and all stakeholders in general, customers as well, to the what's called the Friedman Doctrine, which was derived from a famous article that Milton Friedman wrote in 1970 in the New York Times Magazine, where it shifted from this stakeholder capitalism to shareholder capitalism. And the only purpose, in fact, his stated thesis was the social purpose of a corporation was to serve the interests of the shareholders only and maximize shareholder profit. And since that time, you saw a very, as Michael was pointing out, you saw a very clear stagnation in the wages of working people from 1980 till today. Average full-time workers received 0.1% raise per year over those 40 years. So it's very, and then there were other contributing factors, the Powell memo to the U.S. Chamber of Commerce and other things where business, the power dynamic and the social contract between business and the American people radically changed. And according to the Rand Corporation from 1975 through today, that caused a shift of $50 trillion. So the top 10% of income earners in America got 50 trillion additional dollars than if the wealth and income would have been distributed in the same way that it was from post World War II, the late 40s to the mid 1970s. So I think there's a clear shift, and it was a clear shift in the way, as you know, the speaker continuously points out, it was a big shift in the way that corporations viewed themselves and how they were evaluated, and how even CEOs were compensated. And so, you know, another great metric is the rise in CEO pay versus the median worker. You know, it used to be 1 to 30, 1 to 40, 1 to 50. Today it's 1 to 300. So this massive shift took place in the early 70s, and it starts showing up in the numbers in the mid 1970s to the late 1970s. And by 1980, it was just the wealth and income inequality was just skyrocketing, and has done so for the past 40 years. So I think there's a lot of really solid information about how this transition happened, why it happened, and the complete revision of our social contract and our relationship to business. And during that entire period, not to belabor it, but during that entire period, labor continuously lost power. So workers lost the ability to negotiate higher wages. The minimum wages stagnated, and overall worker compensation declined, both in terms of wages and benefits.
Thank you. Michael, you have anything to add to that? If not, I wanted to say something, if you wouldn't mind.
That was excellent. You've nailed it. You know, that's pretty much what happened. And I mean, it's stakeholder takes a totally different look at things. And I would encourage, please return to the talk on Germany, capitalism, and on Swedish, and you'll see an entirely different approach.
Yeah, and Michael, you could also add that whatever Germany and Sweden are doing, it's something that was tried sometime in the past, not just by FDR's New Deal or Johnson's Great Society, but at the corporate level. Like there is this quote that I think I shared with you from a book by Henry Ford called Today and Tomorrow. It was written in 1926, and this is what he said. He said, the owner, the employees, and the buying public are all one and the same. And unless an industry can so manage itself as to keep wages high and prices low, it destroys itself. For otherwise, it limits the number of its customers. One's own employees ought to be the one's best, goes to be one's own best customers. And he goes on to say, we increase the buying power of our own people, and they increase the buying power of other people, and so on and on. And then he said, it is this thought of enlarging buying power by paying high wages and selling at low prices that is behind the prosperity of this country. So I think he understood that there was this symbiotic relationship between the wages that you pay to your workers and their ability to buy the stuff that you produce. So if you reduce the wages, then you as a producer, you may run into trouble. Now, what we did is we tried to solve that problem by reducing the wages, increasing the pay of CEOs and the top management. And then what did we do? We tell the workers, let them have credit, you know? So, and that's not sustainable, as we found out in 2007.
Might I please interject for just a moment?
Yeah, of course.
Well, it feels like this conversation presumes a closed system, whereas the US economy operates as one economy or one nation's economy in a global system. So that if you artificially inflate workers' wages here, jobs just move overseas and workers don't benefit. And I guess thinking about stakeholder capitalism, I have some doubts as to whether it really ever existed. But to the extent that it did, what do we make of the current interest in ESG investing?
You mean environmental and social goals?
Yes.
Can I
Well,
answer that? Can I
that's a
answer that,
new.
Ibrahima?
Oh yeah, go ahead. Go ahead.
So basically, I completely disagree with you with all due respect. It did exist, and in fact, there are books by business leaders, including the CEO of IBM and others in the 1960s, which talked about stakeholder capitalism and the responsibility of corporations to their employees, to the people who live in the cities where their factories are, and to their customers. And in addition to that, in the last 5 years, we have now seen the Business Roundtable, the largest asset manager in the world, Larry Fink, $7 trillion asset management company, the largest hedge fund manager in the world, all endorse stakeholder capitalism over the shareholder capitalism. And in fact, Jack Welch, who was, as you know, chairman of GE, said that shareholder profit maximization, the Friedman Doctrine, was, quote, the dumbest idea in the world, and fully endorsed stakeholder capitalism. So it is a real force, and it was a real change in the zeitgeist and the social contract of America when businesses decided that profits was their only goal. In fact, you can see an increase in the number of financial crises that occurred after we shifted to shareholder profit maximization. In 82, 87, early 90s, all the derivative crises of the 90s, the Asian crisis, the Russian crisis, the internet bust in 2000, and then of course the 2008. So there's not only a clearly defined line between the rise of shareholder profit maximization and the fragility of our financial sector and the instability in our economy.
But books by
That's
executives
quite a
touting a commitment to stakeholders is not tantamount to actions by executives and corporations actually delivering on those words.
I didn't hear, but
Let me respond to that also.
Okay.
So, Michael, also, I lived in Germany, and I saw this firsthand. And and then they set up an automobile plant in Tennessee, and they wanted to do it the German way, and have some of the workers sitting on the board of directors. And it seems crazy. It's just to someone in our culture, absolutely in the U.S., it seems nutty. And then in no uncertain terms, the governor of the state came down and said, it's not going to happen. Don't even try it. Because the whole political machine would shut down in Tennessee if anyone with money or power, went in that direction. So it was just kind of interesting. But it's just different. And if you lived there and you'd go there, you might see. It's hard to tell. It's not something you can see from afar.
Good. Eddie has a question. Eddie Voltaire. Are you still there, Eddie? Okay, so let's go to Peter. Eddie, you can always come back. Peter Small.
A terrifically valuable lecture, Michael. Sitting down here in Australia and being at the bottom of East Asia, I cannot understand how the Americans are so foolish as to think that their system of financialization of banking and money is going to be the way forward for the future. The rest of the world is going to bypass you. And if you keep on thinking that your system is the one we've all got to follow, you're going to take us down in Australia. We'll go down with you, I'm afraid, because we're stuck with the Anglo-American system, and I'm desperately concerned about the arrogance of American thinking that their system is supreme. It is foolish, and it's foolish because people are rewarded for financialization, as you've explained, and not about productivity. And I think it's been a great lecture, and I hope the Americans who are listening into it take heed of what's been said.
Michael, any comments on that?
Is that at me, Ibrahim?
Yeah, it's
Okay. Yeah. So I mean, I understand your point entirely. I mean, I listen to Australian news frequently now and then, and they've tried Henry George down there. They've tried other things, you know, and it's not. And I from what I understand, I don't know, I haven't been down there, but you have a much more relaxed way of living, and American capitalism sometimes seems so chaotic to me. In fact, the Swedes like to term it that way.
good.
We certainly have a more relaxed way of living.
Can I respond, Ibrahima?
Yeah, go ahead.
So Peter, I agree with you 100%. And in fact, the good news is that most of the business community has recognized that this system is not working. Everyone, as I mentioned, the biggest asset manager, the biggest hedge fund manager, many of the founder of Salesforce Mark Benioff has said, "I'm a capitalist, but our form of capitalism is not working." So there is in the Business Roundtable, which is the premier lobbying group for business, right? 181 of the top CEOs in the country have all endorsed stakeholder capitalism. So there is wide recognition that the system is not working, that there's tremendous amount of unfairness, and even the to bring it back to George's ideas, the very essence of George's ideas, which is rent seeking, free riding, people getting more than they deserve and leaving others in the lurch and massive widespread poverty. That is something that these business leaders are recognizing is undermining the efficacy of our economic approach. And so I think that it's changing, and it took a long time for shareholder profit maximization to take hold. But once it did, it became a very powerful force, and now the pendulum is swinging back the other way. And so I'm optimistic that we're going to see others come out and support these ideas. And someone mentioned the invisible hand earlier. The invisible hand. Adam Smith, in all of his thousands of pages of writing, only mentioned the invisible hand twice. And he did so in very limited circumstances. In fact, he used the term in the theory of moral sentiments, he used the term invisible hand very differently than he did in the Wealth of Nations. And in the Wealth of Nations, he tied it to the butcher, the brewer, and the baker, right, which were three commodity staples of British daily life. So it wasn't, unfortunately, people on the right and these crony capitalists have taken the invisible hand and turned it into this giant philosophical concept, but it's completely contrary to how Adam Smith used the term, and I think it's a very myopic view of capitalism as a whole. Adam Smith did not like capitalists. He actually spoke very in very negative terms against businessmen. He said that they had a mean rapacity and a monopolizing spirit and should not now be nor ever be the rulers of men. So, he put it in context and saying that if you give business people the chance to screw you, They will, because they're focused on profits. And unfortunately, instead of really digesting and understanding the full depth and breadth of what Adam Smith was saying, you know, he's more or less mischaracterized and used to promote crony capitalist dogma and ideology today.
Good point, Tom. Another evidence that Adam Smith is usually misquoted. Whatever he said about the free market and the invisible hand, you know, is very well highlighted. But what he said about taxing land, or at least what he said about the rancher class, those who profit without producing, and of course, what he said about monopolies, you don't see that a lot. Anyway, let's go to Jonah.
Yeah, just back to Michael's discussion about a German company coming to the United States. Do you think that that's sort of? I have two questions. The first question is, could you just repeat the name of it, because I forgot it, and I want to look it up after class is over. But the second question is, do you think that that's like a way that you think stakeholder capitalism can happen, just sort of at a free market level, that people choose to do it on their own, or do you think that it requires changes to the U.S. law system?
Well, it would require some changes in the mind, that's all. Because what it is they set up a system down there, and they were educating all these people. They were schooling them, you know. And in Germany, it's considered honorable to have a job. It doesn't matter what job it is, you know. And they have the schooling for that, you know. You could go to it at any time. I remember when I left there, I didn't stay. I only stayed there 2 years. They would pay for 2 years for you to learn a new profession if you stay, you know, a regular citizen when they live there. So you don't need to really change any laws. You just need to change the way people think. And then they value their employees a lot. And you see the employee, and the culture is just entirely different. You know, that's what it comes down to. It's not like good or bad. It's about what is. This system works for them. That's what they do. And, you know, and you have to honor it. You look at it, you see it, you know, they're not trying to harm anyone. Then they did some very good things, you know, and their policies, like in 2008 in the crisis, they did this thing called Kurzarbeit, you know, where they just let people work overtime, and they would, and the owner and the foreman would work it out between them. In other words, they didn't need them there the whole time. They could take time off. And if they took time off to learn something new, it would be even better, you know. So a lot of them went back into education of sorts. So there's many different ways to look at it. You know, the best way to look at it is actually go there and see it in action.
Good. Yanis.
I'm sorry, just the second part of the question.
Sorry.
What was the name of the company you were talking about earlier?
It was Volkswagen in Chattanooga, Tennessee.
Awesome.
And
Thank you.
there's a good NPR radio report on that as well. And then, you know, send your email to Ibrahim, and I'll send you information on that. Okay.
Thank you. Appreciate it.
Yes, you may go ahead and ask your question. We have, let's add another 5 minutes, Michael, if you don't mind.
No, please.
Okay.
That's why we do this.
Yanni, go ahead.
Yes, thank you. I think Eddie had the question, but he said that there was something wrong with his mic. So I would defer to Eddie if he can put his mic up.
Well, I tried to unmute him, but I couldn't. And I asked him to type the question in the chat, but I don't know if he's monitoring the chat.
Okay.
Go
All
ahead
right.
until he's ready. We can always call on him.
Yes. One question I have, which is a big question, is this: can you have bona fide textbook capitalism with a big government at the same time? It's my impression that when we talk about crony capitalism, that is the fault of government. When you have big inequality, it's the fault of government that guarantees monopolies, and not only guarantees the monopolies, most of the time it funds them with public money. If you didn't have that tilting hand, massive hand that tilts the scales, which comes from government, I don't think capitalism would be like so unequal, and I think you would have, I think labor would have a better chance. But see, for example, right now, $7 trillion were put in the pockets of the big capitalists from all the sectors, banking, tech, you name it. Okay, and voters didn't have a say in it. So it's much easier to control the few politicians than, for example, to go out in the public. So I want you to comment a little bit on the role of big government in corrupting and destroying a true capitalistic system.
Yanis, Michael, I don't know if you are familiar with that book by John Kenneth Galbraith. He calls it Countervailing Powers, where he talks about the three stools of American capitalism: big business, big government, and big labor. So the problem is not to have big government. The problem is when you have big government in bed with big business, and you don't have anyone standing for the the labor class. So it was a balance that was kept for a very long time. And the moment that balance was ruptured, that's where you started seeing corporation basically capturing government. And we saw it very plainly in 2007 during the financial crisis, where we saw government bailing out at the cost of trillions of dollars. And whatever you mentioned, the trillions of dollars that were spent to deal with the COVID crisis is another example of corporate welfare. So it's not necessarily government, but big government is a problem. The problem is a sort of balance of power. Of course, there are simpler way of doing it, notably using the Henry George formula, collecting rent, avoiding rent seeking, and taxing whatever is not production, so that no one will profit without producing.
I totally agree. And my point is that trifecta never works together well. I mean, it's not just in the United States that this vicious circle of corruption happens everywhere. And it happens in advanced economies. It doesn't happen in economies where actually they're very, let's say, they're developing, and there is not social and political savvy about how the economy works. It happens in the most advanced and knowledgeable, economies. So that's what I'm saying. When you have this trifecta, it can never work. That was the point of my question.
Okay, any comments on that, Michael, Tom?
Yeah, I'd like to comment on that. That actually, Yanis, that's a good reinforcement of the conversation that I had earlier about the Friedman Doctrine, because in 1970 you had Milton Friedman's shareholder profit maximization thesis. Shortly after that, you had a number of different prominent businessmen who came out through the Chamber of Commerce and laid out plans, specifically the Powell memo, who Powell was a lawyer and then later became a Supreme Court Justice, Lewis Powell. And it mapped out a strategy for business to influence academia, to influence the media, to influence Washington. And from that time, you went from a small handful of lobbyists, corporate lobbyists in Washington, D.C., to a decade later, virtually every major corporation had a DC office with lobbyists, and until today, and that number has just continued to grow and grow and grow. So you have dark money, you have campaign contributions, you have a tremendous influence from corporations, and that's really how corporations captured the Washington and have dictated policy since the early to mid 80s. And monopoly, we were talking about monopoly earlier. Monopoly policy is one of the greatest examples. In the 60s and the 70s, there were lots of anti-monopoly prosecutions, and and literally the status quo on the right has become now pro-monopoly. And so they're fighting to keep monopolies and allow companies to get as big as possible. And that is definitely, I mean, Joseph Stiglitz's book points out at length how much the monopoly influence in the U.S. is costing U.S. consumers and the U.S. population.
Politically, though,
That's
Tom,
interesting.
I would say that the tables have been turned. It's now the left that is in bed with the big corporations. It's the other way around now. So I think we should be honest about it and not try to play political games. Oh, it's my party. No, what the situation you described was 20 years ago, not now. Now it's the reverse.
Actually, now it's even worse because
it's even worse, I would say.
right, because of Citizens United, corporations literally have no cap on the amount of money that they can donate to politicians, and you know this notion in Citizens United that independent expenditure groups would not coordinate with candidates or receive benefits from candidates was probably the biggest fantasy since Alice in Wonderland. So
but Tom, I didn't hear anybody about the Citizens United complainers complain about how Facebook paid and took over the election process in this election. They paid to dictate, to tell election officials in key battleground states on how to cheat the system. And I heard nobody from the left who were big Citizens United, mouthpieces say anything about Facebook's involvement or the rest of the big tech, which now has changed sides. Okay.
If you want, so let's look at this.
Be honest. That's all I'm saying.
Well, okay, so great. I agree with you 100%. Yes, we should be honest. So there are a lot of different works of nonfiction books and organizations that are dedicated to identifying this. There's Dark Money, the book Dark Money. There's also Open Secrets, which is another independent organization, and they actually track the amount of money that's going to campaigns through various legal inquiries. So if you look at the number of people and the amount of money that's being funded in pro-corporate groups, it's overwhelming. It makes labor donations and teacher donations pale by comparison. So overwhelmingly, the amount of money being spent is in pro-corporate interests.
But didn't Bernie Sanders say that something to the effect that organized people trump organized money?
Who said that? That was one of the wisest things I've heard. Can somebody repeat it? I want to know who said it. It's unbelievable.
Sanders, right? Bernie Sanders, right?
Bernie Sanders.
Yeah, it's a paraphrase of Bernie Sanders has said, but the idea is if you've got the money stacked on one side, you try to stack the people on the other.
Right. And then if you cannot do it, then you get the money like the Democratic Party did. So Bernie Sanders is easy to articulate that, but in practice, they took the big corporations and big Hollywood and the big media on their side. So actually, they couldn't get the people, so they got the money. So in a sense, that's what I'm saying. It's very interesting.
Anyway, so let's not get into political controversies here. There is a question. It's a long one, Michael. I don't know if you can see it on the chat by Eddie Voltaire.
I'm not seeing it.
That would be the last one.
All right.
You want me to read it for you? It's a little long.
Please do.
So if capitalism is based on individual initiative and favors market mechanism over government intervention, and socialism is based on government planning and limitations on private control of resources, the United States is generally considered to be a capitalist country, but most developed countries, including the US, employ a mixture of socialist and capitalist programs, which is true. One reason capitalism and socialism exist together is because of the distribution of various moral foundation traits found throughout the population. how would you define such an economic model? I guess it's quite long. I don't know if you can really
Yeah,
understand.
well,
Yeah.
no, it's like, I understand what he's saying, but it's difficult to articulate because, you know, opposites do exist together. Lots of couples get married that are totally opposite, you know? So they do, it can exist together. But then again, you know, I don't know of anyone more to say that, you know, in this country, if you have, if you have an army behind you, you won't lose anything. You know, anyways, what there's a lot of force and threats made here too. I mean, look, all of the stuff going on now with on the health scene, it's the white elephant in the room no one wants to talk about. You know, the censorship, and then also the total lack of science. You know, on one side, and yet on the other side, everyone thinks we are so divided as a people. It's hard to believe that people just can't just step aside and just say, I quit. I don't want to be in this argument. You know, it seems like someone new enters the argument all the time. I don't know if that is an answer, but sorry, that's what I'm not sure that I can say how there can be a society where someone's not going to be forcing people to sometimes do what they don't want to do.
Well, I think the idea of having a capitalist economy where there is most of it is left to market forces, but as we know, markets fail. So whenever market fails, then you can have some sort of government intervention. I think that that's the model that I've seen working in most countries. You know, next week you will be talking about Germany, and I believe the week after it's going to be Sweden. Right, Michael?
That's correct.
Yeah. So when you see what's going on in those countries, you know that you have both systems coexisting at some point.
Mm-hmm. It's not perfect for them either, but the point is they make a point of always building a consensus. That's the one thing they do. It's a type of
like in Germany, for example, workers are represented at boards. I think it's I don't know if it is mandated by law, but it is a practice. It's really well ingrained in their culture.
They are mandated a voice on the board.
Yeah. Anyway, so I guess we can wrap it up from here, Michael, and then we will wish everybody a good evening, and we'll meet again next week.
Okay, and thanks for your feedback, everyone. This is the best part. I'm sorry I've been talking so long for.
By the way, let me also add your apropos to your comments about Germany. The German Mittelstand, the middle manufacturing, is the sort of the core of their economy. Is the most efficient manufacturing segment of the entire world.
Right.
So
quite
they're
interesting.
Yeah,
yep.
I mean, they export machine tools to China. That's how good they are. And
they have guys living in the Black Forest that are making like medical valves that take like 3 months to make.
Yeah. So my point was that because they have this different model, it hasn't prevented them from being competitive and innovative and successful in industry.
Yep.
They always find a way.
Yeah, they didn't suffer that much also from outsourcing, I understand. So they choose to compete on high end.
Yeah.
Well, they go for a quality market.
Yeah. All right. So.
Okay. Thank you everyone for attending.
Good night.
Good night.
Thanks everyone.